Hi everyone, and thank you for joining us today. My name is Tina, and I'm the Capability Building Coordinator for Connecting Up and TechSoup New Zealand. Connecting Up is a part of the Info Exchange Group. Info Exchange is a not-for-profit social enterprise that has delivered technology for social justice for over 25 years. With over 100 staff across Australia and New Zealand, we tackle the biggest social challenges through the smart and creative use of technology. I'd like to welcome you all to the webinar KPIs for Not-for-Profits, which will be presented by Mick Devine from CalCSA. We'll start with a little bit of housekeeping. All lines are muted, so if you have any technical issues, please type it into the questions box on your webinar panel and I'll be able to assist you through there. If you have any questions during the session, please also type it into the questions box and Mick will answer them in the Q&A section at the end of the webinar. Please note that your comments and questions will not appear to the entire group. If you are on a Wi-Fi connection and have multiple programs open, this can sometimes affect the quality of the audio and video of the webinar. If possible, please close all other programs to help you have the best experience. Please note that the webinar is being recorded and a link to the recording and the slides will be sent to you shortly after the webinar ends. Before we start, I'd also like to remind you that there will be a short survey at the end of the webinar. We'd appreciate it if you took a few minutes to provide us with some feedback. That's all from me for now. I'll pass it over to Mick to get things started. Thanks, Mick.
Good morning, everybody. Thanks for the welcome, Tina. Now, KPIs. Let's maybe start with thinking about why we want KPIs and what they're for, and then we'll look at some examples of financial, operational, and cash flow KPIs and give you a quick look at how we create KPIs in CalCSA and how we report on them. So I guess there's four main reasons why in a not-for-profit you might be looking at KPIs. And essentially, I think a KPI it's a shortcut to having reams of information. It's trying to pick out one or two key numbers that tell you a story about what's happening in your organization. And the four main, I guess, uses of KPIs are in strategic planning, in terms of how are we going against our objectives, are we meeting our plans, what's happening, what's working, what's not working, and numbers come into that somewhere. Governance, are we complying with the rules and regulations that we should be complying with? Again, are there minimum numbers that we need to achieve for different things? Are there maximum numbers that we shouldn't exceed? And the detail of this is going to be different for every organization. And then accountability within the organization is important. You know, when you give someone a task, you want to make sure that they've done it. You want to know how well they've done it. So KPIs are a good way of measuring that, looking at how people have performed. And then the people who give you money often want some sort of outcome measurement because they have their own KPIs to meet back in their organization. So sometimes your KPIs are externally imposed. They want to know, you know, how many beds you've provided for homeless people, how many meals you've provided, those sort of things. And sometimes you don't get any choice about collecting that information and displaying it. Whereas the other ones, the strategic planning, the governance, the accountability, is more internal. So you do get choices about what to measure, what to count, and again, it's about thinking about, do these KPIs drive success in the organization? And I think there's always a danger with KPIs because they're a shortcut in people focusing exclusively on the KPI rather than the big picture of what it represents. So I think I think you need to use KPIs carefully, but used carefully, they can be very useful to measure what you're doing in the organization and what's working, what's not working. Now, I'm just going to talk a little bit about spreadsheets first. Those of you who've done my webinars in the past know that I'm a big fan of standards when it comes to spreadsheets, and I think if you're going to use spreadsheets to do any sort of financial information, anything that people make decisions on, you need to be really sure that your spreadsheet is robust. And every time I do one of these webinars and I talk about spreadsheets, I always talk about the Spreadsheet Standards Review Board. I've been using these standards for many years now, and I think they really help you put together a better spreadsheet. And it's fairly simple stuff. It's, you know, you don't need a degree in computer science to follow their rules, but it is about separating the information on your spreadsheet, the assumptions, the output, the presentation, so that you don't mix that up. It's about separating the constants, the information that you type in there from the formulas, and where you do need to mix it, make sure it's clear that it's mixed. And they suggest, you know, blue for constants, black for formulas, green for mixed. And, you know, the exact colors you use, I don't think really matter. You know, it's about having standards that you apply within your organization so that you're consistent. And when someone else picks up your spreadsheet, and eventually somebody else will, you know, we've all created spreadsheets in the past that we've thought were just temporary and we just used for a couple of weeks or a month until we had a better system. And 3 years later, we're still using that spreadsheet and we've added on 16 other sheets to it and 45 other bits of information, and we have a big tangled mess. So I think by starting all our spreadsheets with good practices, we improve our chances that that spreadsheet's going to be robust. And part of that is documenting what's in there, because most of us don't want to be stuck doing the same job forever and ever, and do want to delegate it to someone else, pass it on to someone else. You know, you want to have holidays. Who's going to look after that spreadsheet while you're on holiday? Are they going to understand it? So document everything and then check everything, validate all your data entry. Excel, Google Sheets, they all have validation rules that you can set on cells so that, you know, if anything's above a maximum, above a minimum, you can highlight it, and then make sure you know which is the latest version of your spreadsheet and share it. Now, when it comes to KPIs, and I am focusing very much on the finance side of things. I can't help it. I'm an accountant, but you know, and the source of most of our accounting information comes from our accounting system. You know, whether we're using MYOB or QuickBooks or Xero or whatever, and it's about exporting that data out of the accounting system, combining it with budgets, which may be in the accounting system, and then putting formulas in there to create your KPIs. Now, I've just got a very simple example here to show you the sort of thing I'm talking about. So we've got a cover page here, and these cells here on my cover page are the only ones that you can actually type numbers into. Yeah. Everything else is locked and can't be changed. I've got a table of contents which has hyperlinks to my different pages. I've got my assumptions. So this is the basic data entry. And in this case, I've exported the income accounts from an MYOB profit and loss report. Yeah. And then I've created a formula at the bottom, which adds up all the self-generated income. I've got another one that links to the total income, which is there. And then on the output side, I have my KPIs here. And now like I said, we often do these things in a hurry. If I was doing this with real best practices, I would have named this range here as July and this one is August, and I would have referred to those named ranges in my formula here rather than B35 and B34. So don't do as I say. Sorry, don't do as I do. Do as I say. You know, we can all improve our spreadsheet practices, but it's about making sure that you've got well-documented spreadsheets. And let's move on from there and talk about some of the KPIs for operations. And I'll give you some examples of these, and we'll look at how we create them in Calxa. I've got a document that we'll share afterwards with all the formulas for the different KPIs that we talk about today. So some of the things that you might measure in terms of operations, you know, will very much depend on the type of organization you are. A member-based organization might be looking very much at the number of members and churn. And churn is the number of lost members compared to your overall members. So if I can just bring across my other screen, so for those who haven't seen it, this is Calxa, and we have lots. Sign me up because I've been idle too long, but we can go back in. That's all right. So Calxa links to your accounting system and gives you lots of flexibility in reports. And one of the things that we do is we have bundles of reports, and I've created one here with all these KPIs that I'm going to talk about today. And I can just run this bundle for any month once it's set up, and you know, all my configuration information is saved, and that'll just take half a minute to just generate all those reports. I pop it out to another tab, and I will give you all a PDF of this afterwards, and I've got the formulas included at the end. So when we're looking at membership, it's very much just the raw numbers, and excuse me. And in Calxa, in our budgets, if I find a budget screen, we have, you can put budgets in for numbers, but you can also put metrics in for non-financial data as well. So in this case here, I've put in each month the budget for the number of members that we're expecting, because we're expecting to grow our members, the number of new members we get, and we realize we're going to lose some members every month, so a budget for those as well. And then I can also put in the actuals. And if I just show you the KPI screen, just to show you how we create that. So current members is just picking up that metric. And just to show you how easy it is to create that, I just go components, metrics, somewhere down here. Yeah, current members. Okay. I nearly had myself worried there for a moment. And it gives you a preview of the last 12 months if you had data in the last 12 months. So on that chart there, that's just showing actuals and budget month by month for that particular KPI. And then the churn's a little bit more complex. Again, I'm showing actuals and budget. So I'm showing actuals year to date, budget for the full year. And let's go to the right screen. So the member churn, first of all, checks that we're not dividing by zero, similar to the way we did in the spreadsheet. And then we're looking at lost members divided by current members. And again, it's point and click to create that. So components, metrics, lost members divided by components, metrics, current members. Yeah, so you don't need a degree in anything to set that. It's simple stuff, but it tells you how well you're doing in terms of retaining your members. And this is one where you want the actuals to be below the budget, because it means you're keeping more members, you're not losing them, because every time you lose a member, you lose their membership fees, you lose the history that they had, and you want to keep them. Wages to income. Wages is a big part of operational costs in many not-for-profit organizations, because it's all about providing services, and you need people, not machines, to provide services. So maintaining a close eye on wages compared to your revenue is an important management tool, and you might do that at the global level for the organization. You might also do it at the cost center level for individual projects or departments within your organization. And wages to income is one of our standard built-in KPIs in CalCSA. If you're ever looking at our KPIs, you'll see the ones that have got a padlock next to them. It's grayed out, so you can't actually change it, but you can see what the formula is and copy and paste it into something else, and you can change the formatting and that sort of thing if you need to. And we put a bit of an explanation there, the amount that's spent on wages for each dollar of income that you've got. So wages to income's a good measure of how you're doing. And in this case, I've got actuals compared to budget, and we're way over budget. So, and we have been all for the last 12 months. So with this one, I've just done I've actually done a rolling 13-month report. I might just maximize that just to make it a bit bigger for you. I like the 13-month rolling charts for my KPIs, because if I'm reporting on September 2019, I can see not just the trends of the last 12 months, but I can also see the same period last year. So I can see that, yep, last year our wages to income percentage was quite high. We've reduced it this year. Yeah. Let's just make that a bit bigger for you. See if that's a bit clearer for you. And then admin to revenue is another. It tends to be something that outside people from outside the organization, especially donor funded organizations, tend to get asked quite often. But it can also be a good governance KPI to to make sure that, you're getting value for what you're spending on administration and not wasting it unnecessarily. I mean, we all know that you can't run an organization without administration. You can't, you can't provide services to people without some sort of administration. So, but, that still doesn't mean, that you want unlimited administration. So having a KPI that measures it is important there. I don't think that should be operations. Yeah, that's right. I don't know what I'm doing here. This should be the finance one. It's right. I didn't change my heading. See, you copy and paste things and then forget. So measuring finance. So I've got a few KPIs here. Debtor days, especially those of you who are in the disability sector or any of the sort of consumer-directed care type sectors where you are invoicing people, collecting money, and it's coming in later, you want to measure how quickly you're collecting it. Those of you who are still grant funded, not such a big issue. But then those who are grant funded, there are problems sometimes with being too dependent on grant funding because you're at the whims of fashions and the political expediency of the government of the day. So many organizations seek to generate their own funds, and so a key strategic objective sometimes is to maximize the self-generated funds so that you're more independent, you're more sustainable, you can cope if there is a change of government with a change of policy, and your particular charity is no longer as fashionable as it was last year. Then unit costs, again, those of you in that consumer-directed care, NDIS, aged care, that sort of thing, where you're effectively selling your services often for a price that's fixed by somebody else like the NDIA, then you need to understand what the costs of those services are so that you know if they're profitable. And then the net equity is just a general financial KPI. Are your assets greater than your liabilities? They should be. It's unusual for not-for-profits to have high debt, but it can happen, especially when you've purchased property which may have decreased in value or all sorts of reasons. But from a governance perspective, it's one of the things that you want to make sure is managed well. So let's just have a quick look at each of those. So debtor days, and I've done a report by quarter for the last 3 years or something here, just to mix it up a bit. And you can see that our average debtor days was dropping for the first couple of years, and then it went up last year and it started going down again. How do we calculate debtor days? Let's go back to my formula. This again is one of our built-in KPIs in Calc, so you don't have to set this one up. But basically, it's trade debtors divided by debtor income. And these are account groups, and we haven't looked at account groups yet, so we better do that. So trade debtors, is in the balance sheet section. So trade debtors is essentially our accounts receivable account out of our accounting system. And in our settings here, we pick that up from the accounting system, but you can nominate it here. You can nominate multiple accounts receivable accounts or accounts payable accounts. Usually the only reason you'd want to do that is if you've got multi-currency debtors or creditors, but and that feeds into our trade debtors account group. And then what was the other one? I've already forgotten it. In that formula, let's see, it's handy having the formulas here. We can just go back and have a look at it. Debtor income. Now we've got an account group called debtor income, which is here, and that looks at all our income accounts where in the cash flow settings we haven't nominated them as being received in the current month. So anywhere we're collecting in any period other than the current month. So that's what that formula does, and then it divides it by 365. So as I said, I've got copies of these formulas, so you don't have to remember them, take notes, but it's basically your current debtors divided by the annual income that is invoiced times 365 to give you the number of days. So and then self-generated funds. With this one, I've created an account group for self-generated funds and divided it by total income. And that account group I've selected, you basically just tick which accounts to include in that group. So it's simple stuff. And then if I just show you, if I just delete that again, the first part's just the checking that we're not dividing by 0, but we go account groups, self-generated funds divided by account group total income. And total income is one of our built-in groups, so you don't have to create that. It's just all your income accounts. And that gives us a percentage of the income. And I've run this by project, so I can see which projects have self-generated income. And you see some of them have none. This one here's got 41%, this one's got 12%, and this one here is all self-generated, and this one here's got 1%. And overall, we're generating 6% of our total income. So it's just different ways of looking at that information, being able to look at it at the organization level and also at that project level. What do we got next? Unit costs. So how do we measure unit costs? And this one I've got actuals, I've got budget, I've got last year's actuals, and I'm starting from this financial year. And we're only 3 months in so far. And our costs are under budget, but above what we had last year. So again, where does that information come from? Our formula somewhere here. No, I think I put them all up the top. Did I? Yep. I put an A at the beginning just so I'd get them. It's total expenses divided by number of participants, and the number of participants again is one of the metrics. So in the budget, for each cost center that you're looking at, you select metrics, and you just go add metric and create a new metric, and I've got 2,000 participants every month for my budget, and in my actuals I've got slightly different numbers to that each month, and then it combines that with the total expense, which has come from our accounting system. So you could, if you didn't want to take all the expenses that relate to that particular cost center, you could redefine what that total expense is. It might be just some of the operational expenses and not include overheads and admin and that sort of thing. But on other occasions, it may make sense to include that. So you can control what gets counted in there. And I know when I first started doing work with organizations transitioning to NDIS a few years ago, there were consultants out there handing around spreadsheets that had about 20, 30, 40 sheets with all these complicated calculations for labor and materials and on costs and everything else, and they expected people to sit down, fill them out. It'd take an hour just for the data entry if you had the numbers easy to hand, and it was just a big laborious process. Whereas you have that information in your accounting system, you're measuring those costs there, you've got your budget, so you've said what you're expecting to spend. You can put a budget in for the number of participants, you can put a budget in, you can put numbers in for the actual participants, divide one by the other. It's not hard to do. And by doing something that's easy to do, it means you can do it every month. And whereas if you've got a spreadsheet that takes hours of work to do, you're not going to do that every month for every single project, every single activity. You need to have a system that lets you produce that information quickly and easily. Once we've got these KPIs set up in here and in this bundle, we can you saw how quickly I just generated this whole set of reports. You can also create a workflow that will email it to you on the 1st of every month or the 10th of every month as well. So, producing reports shouldn't be laborious. That's me off my soapbox now. All right. Now, net equity, as I said, it's total assets minus total liabilities, or just the sum of the equity accounts, and ideally it's a positive number. Yeah. And in this case, our total equity is about 400,000, and it's fairly consistent. For some reason, we had high expectations in our budget last year, which we didn't meet, but this year we're much closer to budget. Looks like we've reassessed the budget this year, and it's a bit more realistic. And again, the actual formula is simple. If I can find it, net equity position. I've got an account group called net equity, and it's a balance sheet one. There you go. and I've just ticked which accounts I want to include there. And basically I've just ticked all the equity accounts. So simple stuff, but as a board member, it tells you that this business isn't going down the drain. If that net equity line was going down at a rapid pace from month to month, as a board member, I'd be worried. And as a board member, I've been worried about cash flow many times in the past, and I think boards often don't get enough information about cash flow management, and it's one of the vital responsibilities of a board member is to understand that the organization you're running is sustainable and solvent. And I think the simplest of cash flow measures is the current bank balance. Have we got money in the bank? And where's my chart? And in this case, where's the actuals? We've got $150,000 in the bank, going up $200,000. And I've done this one from the beginning of the calendar year. We've got $30,000 or $40,000 more than we had last year. Not as much as we expected to have in our budget, but but being able to see that trend line and seeing that we've managed to keep that consistent over the last 18 months, with that small growth over time, that would give me a lot of confidence as a board member looking at that. Yes, I know we haven't reached the dizzy heights that the budget said, and I'd be asking some questions about why that was and what we had in the budget that didn't happen. But just having that cash balance there, and again, that's one of our built-in KPIs. You don't need to set that one up. There's it's just the default bank accounts. Actually, that could be, depending on how you've set calcs up, that could be multiple bank accounts. Now, cash reserves in days. This is much more a forward-looking one. Just seeing the actual bank balance is looking back at the past. And even though we had a budget in that last one for the future, I also know that we didn't meet that budget or come very close to it at all. So knowing our cash reserves is important too. And what do we mean here? It's the amount of cash we have and divided by our daily expenses. So typically we'll take our total expenses for the year and divide it by 365 to get the daily, and then divide our current cash balance by that. So the idea is this tells you if you didn't get any more money into from now on, how long would you last before you have to close the doors? And in this organization, it's 240, 250 days. And, 18 months ago, it was 168 days. And generally, anything over 90 days is considered comfortable and sustainable. If it's less than 90 days, your risk increases of not being able to meet your needs. So having it's giving you a good idea of how that cash balance is compared to your normal expenditure. And again, this one's a custom KPI, but it's cash reserves divided by annual expense, which is one of our built-in account groups, and then I've created a group for non-cash expense to deduct from that, because you only want to look at the cash-based expenses. So you take out things like depreciation, long service leave accruals, those sort of things, and then divide those by 365. What do we got next? Working capital. Another one that gives you a bit of a leading indicator of cash flow problems. What it is it's your current assets, so the cash, inventory, debtors, things that you've got that are, you could potentially liquidate within 12 months if you needed to, compared to your current liabilities. So credit cards, GST, PAYG, payroll liabilities, short-term loans, that sort of thing. And the absolute minimum that is normally considered sustainable is a ratio of 1. So current assets are equal to current liabilities. Less than 1 suggests you've got some serious cash flow problems. This organization has got 5. So our current assets are 5 times our current liabilities. That's a comfortable position to be in. So that reinforces that cash reserves in days, saying, yep, we're fairly comfortable in this organization. And, not-for-profit organizations don't often have high liabilities, but it does happen, and it can happen especially in smaller organizations where you don't have many assets either. If you take out some loans, take out some credit cards, you buy goods on credit, you haven't paid your GST yet, you haven't paid your super for the staff, it is possible to get into trouble. And as a board member, you need to be aware of that. You need to manage that and make sure that your organization's going to still be around next year and the year after. And lastly, in the cash flow section, I've got creditor days. And creditor days, this is the average number of days we take to pay our suppliers. And this organization's fairly slack, really. This time last year, it was 120 days. It blew out to 270, but now it's come back down to 102. You shouldn't use your suppliers as a bank, and most not-for-profits don't. But again, if that number was blowing out, I'd be asking what's going on. Why can't we pay our bills? What are we doing? And just for a comparison here, I'm showing the debtor days, which is how we collect money from our customers. So, and whether you have customers that pay you on invoice will depend on the type of organization you are. If you're putting invoices through to the NDIA, for example, you'll have debtor days. If you've got members who get invoiced every month for their membership fees, you'll have debtors. And from a cash flow perspective, ideally, you're paying your suppliers after you've, especially if you're if you've got a retail branch or something, you want to make sure that your creditor days is higher than your debtor days, so that you're not funding the cash for that retail operation. And then I have here, so I'll make sure Tina distributes this document to everybody with all these formulas. And if anybody needs some more information on Calxa, there's some on the on the Connecting Up or TechSoup website. We do a donation for most organisations with a turnover of less than $1 million, and a discount for those of you who are above that. And there is a 30-day free trial on the Calxa website. Tina, have we got any questions?
Thanks, Mick. We haven't had any questions come through. So was there anything you wanted to add before I wrap up?
No, I think I've covered everything I was planning to cover. So, but if anyone wants, I'm happy if you give people my email if they've got questions after that they think of afterwards and they want to send me an email. Happy to do that.
Fantastic. I'll include your details with the recording that I send out. So thank you so much for presenting today, Mick, and thank you everyone else for joining us. Hope you've all learned a lot from the presentation. If you do have any questions that come to mind later on or any feedback about the webinar, please send that through to events@connectingup.org and we can answer those questions offline. I'll include Mick's contact details with the slides and the recording that I send out later today. Again, thank you for being with us. Enjoy the rest of your day. We look forward to seeing you all next time. Thanks, Mick. Thanks, everyone.
Thank you, everybody.